Every trader thinks they understand how to trade supply and demand, but if that was true, 90% wouldn't be losing by trading off of the wrong zone. So in today's video, I'm going to take you guys A to Z on how to trade supply and demand with 100% precision to make sure you don't trade off of the wrong zone. So get your pen and paper out and tune in, because this video is about to be the only video you need to understand supply and demand in depth.
Now, in this lesson, we're going to go through what is supply and demand. So let's get right into this slideshow. So what is supply and demand? Now, when explaining a new term, I always like to start with a simple definition. Supply equals sell and demand equals buy. And of course, it isn't as simple as that, but it's a general idea. An area with increased supply refers to an area with increased selling pressure and vice versa, whereas an area with increased demand refers to an area with increased buying pressure. Okay, let me move over to the next slide. I want you guys to familiarize yourselves with three key words before we get started. The first one being rally. Now, the term rally just identifies an area where buyers exceed sellers. Then we got the word term base. Base is when sellers and buyers are equal to one another. Drop is when sellers are exceeding buyers, and you're going to see a lot of those terms being referenced on the charts, and you'll see it in much more detail. Let's move over to the next slide. So there are two types of zones that I am going to take you guys through. The first one being a continuation zone, and the second one being a reversal zone. But let me break down to you guys what they are first before I show you some visual explanations. Okay, so supply and demand zones are divided into two types. Before we go any further, let's talk about the two kinds of supply and demand zones. Although supply and demand zones are the same thing, they are divided into two categories depending on whether they form as a result of a reversal or as a result of a continuation. The following examples I'm going to show you guys now is one being a continuation zone, which are forms of a rally-based rally or a drop-based drop. Scenario number two is when you have some reversal zones, and reversal zones are formed when you have a rally, a base, and a drop, or a drop, a base, and then a rally. All right, so now we're going to go through some examples to illustrate what this actually looks like, so you guys can understand the difference between both types of supply and demand zones. So first, we're going to go for continuation zone, as that is the easiest and most common concept that people I have identified before. So continuation zones, these are types of zones that form when price moves in one direction and then consolidates or pauses in price and then continues in that same direction. Now, in this example that I've illustrated right here, we have a rally where price is shooting over to the upside. It then begins to consolidate. Here you can see it's starting to accumulate more buyers into the market, and then it continues with another rally. This is an extension and price continuing in its intended direction. So in essence, you have a low, you have a higher high, you have a higher low, and then you have a higher high. Okay, now that price has proven and printed a series of new higher highs, this area where we saw that continuation and that pause acts as an area of demand. Okay, and vice versa. In this case right over here, we have a drop. Then we have that continuation, that pause in price where price is redistributing. And then we see another drop continuing in its intended direction. We have a high, we then have a lower low, we then have a lower high, we then have an even lower low. Okay, so at that continuation where price created that base, this is an act of supply. Now, let's get into some chart examples. As you guys can see over here, price was moving over to the upside. We then had that drop, which took out this low. Once price shifted and it created that drop, we had a pause and an area where price began to consolidate, creating that base. And what followed after that consolidation is another drop. So we have a drop and a base and then a drop. Once we have identified these three steps, we mark out our base as an area of supply. We then wait for price to pull back into this base where we can then look to execute some of our sell positions, okay? And vice versa. in this scenario right here, you can see price rallies. We then had that pause and price began to consolidate within this region over here. And then what follows right after? Another rally. Okay, so we have rally, base, rally. Now that we've identified these three things again, we mark out our area right over here as an area of demand. We then wait for price to deliver back into this point where we can expect a continuation to happen and price continues to deliver in that intended direction. Okay, so you guys can see here once again, drop, base, drop. This is an act of a continuation zone, and at a continuation zone, we just expect price to continue in the direction that it has set for us. So because price has dropped, taken out lows, when it pulls back into our continuation zone, we expect it to continue to short from that point as well. That is why we would look to execute sells from this level. In this case right here, we have a rally base rally, so we are bullish. When we get that pullback back into this continuation zone, we expect price to continue with that bullish momentum. Okay, so that is an example of a continuation zone. Let's move on to what a reversal zone looks like. Reversal zones is the same concept as trading order blocks. It forms when price reverses direction and then sets off a new swing. So here's some visual drawouts that you can see. At this point right here, price created a low and it rallies over to the upside, forming a higher high. Okay, what ends up happening when price creates that higher high? We have that area of consolidation where price is beginning to distribute now. Once price begins to distribute, we then have that expansion out of that area, forming lower lows, which broke that previous level. So we first identified a rally. We have then identified a base, and then we have identified a huge drop which broke structure. This is how we identify a change of character. This signifies for a reversal. Once we have these three things identified, we now wait for price to pull back into this base, expecting for a reversal to happen. Now that we've seen that drop which took out this low and we have identified a reversal zone, when price pulls back into that level, we no longer expect it to continue to the upside. We expect it to reverse and shift even lower. Okay, so this is an example of a reversal zone and vice versa for the other way around. In this case right here, we have that drop. After that drop, price consolidates and begins to accumulate some orders, and then it is followed by an expansion to the upside, which took out that previous high. Okay, now that price has taken out that previous high, this signals for a reversal because price has now broken structure to the upside. That is our change of character. Apologies for that, I should say change of character. So we have that drop, we have that base, then we have that rally which explodes over to the upside, taking out that previous high. So now when price pulls back into this area of demand, we expect it to reverse and continue over to the upside. Okay, we are no longer bearish because we've had that rally. We expect price to continue in that rally. Okay, let's go through some chart examples. So in this case over here, you can see price continues to the upside, taking out this previous high. Okay, what ends up happening? Price begins to form a distribution at that base that we have marked out over here. It is then followed by a huge drop, which takes out this previous low. Now that this previous low has been taken out, we mark that out as a change of character. Now that we've identified a change of character, this confirms the reversal zone for us. We have that rally, we have that base, we have that drop. So now when price pulls back into this base that we have marked out as a reversal zone, we will look to execute some shorts from that point. And the same goes for the other way around. We have that drop right over here. Once price begins that drop, it begins to accumulate orders, which is then followed by a move over to the upside, which takes out this previous high. This is identified as a reversal, which is why when we mark out our base, this is a reversal zone and not a continuation zone. So when price pulls back into this area, we then look to buy up to continue that last rally. Okay, now to the main and the most important question that you guys all have, and that is when identifying multiple zones, which zone do I choose? Okay, now this is a very important question and it is something that we all need to understand. Let's move over to the next slide. Equilibrium, discounts, and premium pricing. When it comes to identifying multiple areas to execute from, you must have a greater understanding in knowing where the discounts are in price and where the premiums are. In order to identify those areas, we must first know how to identify the equilibrium, which is the midpoint of the range. Okay. Now, the equilibrium is the midpoint of a price range or the midpoint of a swing. It is the level at which an asset is neither cheap or expensive. Therefore, this wouldn't be a level we would want to execute a position from. We want to be buying in at cheaper rates, which is below the equilibrium level. And we would want to be selling at a premium, which is above that equilibrium. But how do we identify that equilibrium? Let me show you guys now. So this is a brief chart example of what it would look like. So imagine this is the swing low and this is the swing high. That 50% level between these lows and these highs is that equilibrium point. That 50% level between these lows and these highs, okay? Anything above the equilibrium is what we would identify as a premium level. So if we were in buys from this point, we will be looking to short anything above the 50% and vice versa. If we were in sells from this level, we would look to take profit anything below the 50%. Okay, so I hope this is a good example, but now let's show it on the charts. Now that these levels can easily be identified using our Fibonacci tool, the levels we are interested in are the 70.5 level, the 79 level, and the 88.6 levels. All of these are discounted and premium points within our Fibonacci where we can look to identify these very important levels. Now, for long entries, your Fibonacci has to be drawn from the swing low to the swing high, which we will show an example of, and the opposite when looking to go short. The whole point of buying at a discounted level is to allow the trader to simply execute their trade at a better price. All right. Now with the knowledge that I have shared with you guys, which demand zone would I look to take an entry from? The most important thing here is that you have to look at our Fibonacci levels. I want you guys to pause this and identify which level you would want to buy from after hearing all of the knowledge that I have just shared. And the correct answer is Zone B. And let me tell you why. Now that price has rallied over to the upside. First, we have that drop, then we had that base, then we had that rally, which took out this high. We have identified our change of character. We have identified our reversal zone. Okay. When price rallies over to the upside, you mark out the swing low into the swing high. Once you've marked out the swing low into the swing high, you identify where the discount is within this new range that is formed. Okay. Now, this is the midpoint of that range, which, funny enough, aligns with this zone A that I have drawn out here. Now, what did I say about an area at an equilibrium? Price is not interesting to us when it is at a level of equilibrium, as it is nor cheap or expensive. When we are looking to buy, we are looking to buy at cheaper prices. So anything below the 50% is considered a discount. Now, when you're looking at zone B, it is a very nice level of demand, which has some inefficiencies right above it. And it also aligns with our 70.5%, which I mentioned in the last slide. If I just go back for a second, you guys can see the levels we are interested in are the 70.5, the 79, and the 88.6 level. So this level of demand, the open of those cells, aligns with the 70.5. So the 70.5 level is where we would want to take some buy positions from. Okay, so now that I've taken you guys through the slide, I'm going to go ahead and show you a chart example on NASDAQ. So we are looking at the NASDAQ right now. What can we see? So price has taken out these lows. Okay, That is the first thing we identify. So we have a drop. Price then begins to shift over to the upside, eventually coming up to take out this previous structure. This right here is what we would identify as our change of character. Not only that, this was also a previous level of supply that price has completely violated. Okay, so if I just mark that out, remove the extension, price has violated through this level of supply and taken out this high, confirming that shift in trend. Now that we have identified this and price is beginning to pull back after forming this higher high, what do we go ahead and do? This is the confirmed low, this is the confirmed high. I'm going to go ahead and identify a discounted level within this price range. So we mark out the lows and we mark out the highs. Now, there are two levels that I am keen on. We have this area of continuation right over here. We mark that out as a level of demand. And we also have this area right over here, which is also a form of demand. Okay. Now, looking at this price action, understanding this price range, this being the swing low and this being the swing high and this being the equilibrium point. We have an area of demand here and an area of demand here. Now, if I as a trader wanted to scale in buys, would I want, this is the thinking you guys need to have. As a trader, when I'm looking to buy into an asset, do I want to buy at an equilibrium price where it's neither cheap or expensive, or would I want to buy something when it's at a cheaper price? So out of these two levels, which is more probable for me to take from, to enter from? Okay, let me just add the 0.5. Okay, now out of these two levels, which will be of my interest to execute from? Now, looking at our Fibonacci tool, we can see this is the 50%, and this is the 70.5%, and this is the 79%, and this is the 88.6%. This area of demand aligns just in between the 79 and the 88.6%. And what did we say about these levels? These are the levels we are interested in. So rather than looking to execute buys from this area of continuation, which is valid, but isn't probable as it is in align with the equilibrium. What is more probable for us is the discounted levels, which aligns with our 79 and our 88.6%. So by knowing this, I'm going to go ahead and place buy orders at this level of demand, as it is a more probable level for me to execute some buy positions from. Now let's play price and see what ends up happening. So you guys can see we are starting to see some rejection from the 50%, but will it hold at that level? Absolutely not, because price is at the equilibrium and it is not cheap or expensive, so it is no interest for an institutional trader to execute orders from that point. An institutional trader wants to be getting in at those cheaper prices so he can maximize on his gain. So we simply wait for the pullback, and that is what had happened. Price eventually came down to tap into this area of demand, gets into those discounted prices, and hopefully we can then see that continuation all the way back up to the upside. And just like that, price hit take profit, simply with us identifying that this level is the more probable one. So this is the area we would want to be executing our position from. Okay, guys, that is the lesson done. I hope this breaks down what is supply and demand, and I hope you guys now understand how we go ahead and identify which zone to trade from, because I know how difficult it can get sometimes. You will mark out a chart and you will have 5 different levels, and then here's you sitting behind your desk trying to identify which out of those 5 levels am I going to enter from. Just by using your fib tool, just by understanding where the discounts and the premiums in price are, I hope that will confirm for you guys the level that you should execute from. Anyways, guys, see you on the next lesson.